If investing ever felt stressful, confusing, or overwhelming, you're exactly the kind of person I made this video for. My name is Alex, and I want to show you how I would invest $10,000 without trading, stress, or constant market watching. Before we begin, if you appreciate calm, realistic conversations about money, consider liking this video to support more content like this. YouTube shows videos you engage with, so liking genuinely helps other people find practical investing guidance without hype or fear. Also, share this video with someone who worries about investing but feels overwhelmed by charts, predictions, and financial noise. And if you want future videos about long-term investing, passive income, and building wealth patiently, subscribe to the channel now. I don't promise shortcuts, secret tricks, or overnight success, because real wealth usually grows quietly, slowly, and consistently. Most people think investing means constant buying, selling, and reacting, but that belief creates stress and destroys long-term returns. I learned that the hard way, watching smart people underperform simple strategies because emotions kept hijacking their decisions. So today, I'll walk you through how I personally would invest $10,000 using Fidelity index funds. Or no, this approach requires no trading, no market timing, and no daily stress about headlines, crashes, or sudden price movements. Everything I share is designed for regular people with jobs, families, and limited time, not professional traders. The goal isn't to beat everyone else, but to build a reliable system that works even when markets feel uncomfortable. If you've ever worried about doing something wrong with your money, this framework is built to minimize mistakes. Over the next 20 minutes, I'll explain each decision clearly, using simple language anyone can understand. I'll also show why doing less often leads to better results, especially when investing over decades instead of months. By the end, you'll understand how calm investing works and why stress is usually the most expensive cost investors pay. This isn't theory from textbooks. It's how I think about money when real emotions and real consequences are involved. Let's start with the biggest mistake I see most investors make when they first try investing $10,000. That mistake isn't choosing the wrong stock. It's believing they need to constantly do something to succeed. Most people feel productive when trading, but activity often hides anxiety, impatience, and a deep fear of missing opportunities. I used to think checking markets meant control, until I realized constant monitoring usually creates worse decisions over time. Research consistently shows frequent traders underperform simple index strategies, largely because emotions overpower logic during volatility market cycles. That's why I removed trading entirely and focused on building a system that works without constant decision-making. When I invest, my priority is survival first, because staying invested matters more than chasing impressive short-term gains. Losing money hurts, but losing confidence hurts more, because panic leads people to abandon good plans prematurely often. This is where index funds quietly shine, because they remove pressure to predict winners or react emotionally every day. Instead of betting on one company, index funds spread your money across hundreds or thousands of businesses worldwide today. Some companies will fail, others will thrive, but the overall economy has historically grown over long periods of time. I'm not trying to be smarter than the market. I'm trying to be more patient than it consistently. Now, if I'm building a no-stress portfolio, index funds become the foundation, not the exciting side piece. But not all index funds are equal, which is why choosing the right provider actually matters long-term. I personally choose Fidelity because of low fees, long history, and a focus on everyday investors like me. Fees might seem small, but over decades, high costs quietly steal massive portions of your future wealth away. Paying 1% instead of 0.03% can mean hundreds of thousands lost over decades. That's money you worked for, not something you should casually hand over to unnecessary fees for decades ahead. So when I choose Fidelity index funds, I'm buying efficiency, simplicity, and peace of mind for my future. Next, I want to explain the 3 rules I use before selecting any fund for my portfolio decisions. These rules help me stay calm during crashes and confident when markets feel uncertain or emotionally overwhelming periods. If those things matter to you, The next part will likely change how you think about investing forever. Before picking any fund, I follow 3 simple rules that protect me from emotional mistakes and unnecessary stress. The first rule is survival, because any investment plan must withstand bad years, recessions, and uncomfortable market downturns. If a portfolio collapses emotionally during crashes, it doesn't matter how strong the long-term returns look. I want investments that help me stay invested when headlines scream panic and people around me lose confidence. The second rule is diversification, meaning each fund should play a different role instead of overlapping the same risks. I don't want 3 funds doing identical jobs, because that creates hidden concentration and false confidence. One fund should focus on long-term growth, another on stability, and another on income and resilience. This balance allows my portfolio to breathe, even when one part struggles while another quietly carries weight. The third rule is cost, because fees are guaranteed expenses, while returns are never guaranteed. Keeping costs low gives me an advantage before the market even starts working for me. With those rules set, choosing funds becomes less emotional and more about structure, discipline, and patience. Now let's talk about the first fund I would include, which focuses primarily on long-term growth. Growth matters because inflation quietly erodes cash, and I need assets that can outpace rising living costs. This fund isn't about chasing trends. It's about capturing innovation across the economy consistently. I prefer broad exposure rather than guessing which single company will dominate the next decade. That mindset removes pressure and lets the economy work instead of fighting against unpredictable market movements. Over long periods, diversified growth has rewarded patience far more reliably than frequent trading decisions. Even during volatile years, staying invested has historically beaten jumping in and out repeatedly. This growth-focused fund forms the engine of my portfolio, pushing long-term value forward steadily. But growth alone isn't enough, which is why the next fund plays a very different supporting role. The second fund I choose focuses on stability, because emotional comfort matters just as much as mathematical returns. This fund invests in large established companies that generate consistent profits across many economic environments. These businesses aren't exciting stories, but they quietly produce cash, jobs, and products people rely on daily. When markets fall sharply, stable companies often decline less, helping investors avoid panic-driven selling decisions. I like knowing part of my portfolio is designed to absorb shocks rather than amplify fear. Stability funds act like shock absorbers, smoothing the ride when markets feel unpredictable and emotionally exhausting. Historically, large-cap diversified funds have recovered faster after downturns than concentrated or speculative investments. This stability gives me confidence to stay invested, even when headlines suggest everything is falling apart everywhere. Without this foundation, many investors abandon their plans at the worst possible moment during market stress. That's why stability isn't boring to me. It's what keeps long-term strategies actually working. Now, while growth and stability matter, income adds another powerful psychological and financial advantage. The third fund I choose focuses on income, providing cash flow regardless of daily market price movements. Receiving income helps investors feel progress, even during flat or declining markets over extended periods. Dividends reduce pressure to sell shares when emotions are high and confidence is temporarily shaken. I like knowing part of my portfolio pays me simply for owning productive assets long-term. Income-focused funds often invest in sectors that remain essential, even during recessions or economic slowdowns. Energy, materials, and infrastructure still matter when technology stocks face uncertainty or valuation adjustments. This diversification provides balance when growth temporarily stalls, and stability alone feels insufficient. Income doesn't replace growth, but it supports patience, discipline, and emotional resilience over decades. With these 3 roles defined, I can now explain exactly how I'd allocate $10,000. If I were investing $10,000 today, I would divide it intentionally, not evenly, based on each fund's role. Allocation isn't about perfection. It's about creating balance that matches real human behavior during stressful market periods. I'd place the largest portion into the growth-focused fund because long-term appreciation drives overall portfolio expansion. This portion benefits most from time, compounding, and reinvested gains over decades rather than short cycles. Next, I'd allocate a meaningful portion to the Stability Fund to reduce volatility and emotional drawdowns. This helps me stay invested during downturns instead of making regretful decisions driven by fear or headlines. Finally, I'd allocate the remaining portion to the income-focused fund for cash flow and psychological comfort. Even small income streams can dramatically improve investor discipline during periods when markets feel discouraging. Together, these allocations create a portfolio designed for humans, not spreadsheets or theoretical models. The exact percentages matter less than committing to a plan you can follow consistently for decades. Once invested, the most important decision is often doing nothing while allowing compounding to work quietly. Constantly adjusting allocations usually reflects emotional discomfort, not improved investment insight or strategy. I rebalance occasionally, but only with intention, not reaction to short-term noise or fear. This discipline protects me from chasing performance after it already happened and missing future growth. Now let's talk about what realistically happens to this portfolio over time, without exaggeration or hype. Long-term investing rewards. Patience unevenly, meaning progress feels slow before suddenly becoming very powerful. Early years rarely look impressive, which is why many people quit before compounding reveals its strength. The real results appear later, when time multiplies steady returns into meaningful financial independence. Understanding this timeline helps set realistic expectations and reduces anxiety during the quiet early stages. Next, I'll walk you through how this investment can evolve over 1, 10, and 30 years. In the first year, this investment rarely feels life-changing, but that slow start is completely normal. Early growth mainly builds momentum, not excitement, which is why patience becomes an investor's most valuable skill. After 10 years, compounding begins showing clearer progress, as growth and reinvested income start reinforcing each other. This stage often surprises people, because steady consistency quietly outperforms aggressive strategies abandoned too early. By year 20, time becomes the dominant factor, amplifying small annual advantages into significant portfolio value. At this point, most of the money working for you comes from growth, not your original contribution. 30 years later, the difference between calm investing and emotional trading becomes dramatically obvious. The portfolio's value reflects decades of discipline, not intelligence, luck, or constant decision-making. Reinvested dividends play a powerful role, quietly buying more shares regardless of market conditions or sentiment. This automatic reinvestment accelerates compounding without requiring effort, timing, or emotional involvement from me. Importantly, these outcomes depend on staying invested, not achieving perfect returns every single year. Missing just a few strong years can dramatically reduce long-term results, often permanently. That's why I focus less on predictions and more on building habits that keep me invested consistently. Now it's important to address the risks honestly, because no investment strategy is completely immune. Markets will crash, headlines will scare people, and portfolios will temporarily lose value at times. The question isn't whether downturns happen, but whether your strategy helps you survive them emotionally. My approach prioritizes staying calm, because panic selling permanently locks in losses unnecessarily. Having diversified roles makes downturns easier to tolerate compared to holding one concentrated investment. This emotional resilience often determines success more than market knowledge or advanced financial expertise. Next, I want to share common mistakes I see people make that quietly sabotage long-term investing results. One of the biggest mistakes I see is people constantly changing strategies whenever markets become uncomfortable or uncertain. Switching funds frequently feels productive, but it usually reflects fear, impatience, and a lack of long-term conviction. Another mistake is selling during downturns, locking in losses instead of allowing recovery to eventually occur. Markets have historically recovered, but only investors who stayed invested were able to benefit from that rebound. Many people also chase performance, buying funds after strong runs and abandoning them after weak periods. This behavior guarantees buying high and selling low, even though people intellectually understand it's harmful. Overreacting to headlines is another silent killer, because media profits from attention, not long-term investor success. I intentionally limit how often I consume financial news to protect my mindset and decision-making process. Emotional decisions feel urgent, but they rarely improve outcomes when measured over decades instead of days. Having a clear plan before volatility hits prevents panic when emotions try to override rational thinking. That's why I define rules early, so future decisions don't rely on how I feel in stressful moments. Another mistake is underestimating time, because compounding requires patience that many people never develop. People often quit just before results accelerate, mistaking slow progress for failure or poor strategy. Successful investing rarely looks impressive in the short term, which makes discipline incredibly difficult. Understanding this helps me ignore comparisons with others who appear successful but lack sustainable systems. Now, I want to address a question I receive often about starting amounts and realistic expectations. $10,000 won't change your life immediately, but it can change your financial trajectory permanently. The goal isn't instant wealth. It's building a foundation that future contributions and time can amplify. Consistency matters more than starting perfectly, because progress compounds from habits, not ideal circumstances. This mindset removes pressure and allows investing to support life instead of dominating it emotionally. When people ask if now is the right time to invest, I remind them consistency matters far more than timing. Waiting for perfect conditions often means missing years of compounding that can never be recovered later by investors. I prefer starting with what I have, then adding gradually, instead of waiting for certainty that never arrives. Even imperfect investing usually beats perfect planning that never turns into real action for long-term wealth building. Over decades, small regular contributions can matter more than any single investment decision made early in life investing. That's why I focus on building a repeatable process rather than predicting short-term market movements consistently over time. This approach removes pressure to be right constantly and replaces it with patience and discipline over long periods. I also remind myself that volatility is normal, not a signal that something is broken or failing temporarily. Markets move up and down, but long-term progress depends on participation, not prediction accuracy over many years. Having income, growth, and stability working together makes those movements easier to tolerate emotionally during stressful market cycles. This balance gives me confidence to keep investing during uncertain periods instead of pulling back emotionally and financially. Over time, this consistency transforms investing from a source of stress into a background support system for life. Money should help you live better, not dominate your thoughts or daily emotional state over long periods of time. That's why no trading and low stress aren't weaknesses. They're deliberate advantages built into my strategy for long-term success. When markets are calm, this strategy quietly compounds without demanding constant attention or intervention from me emotionally daily. When markets are chaotic, the same strategy protects my mindset from panic-driven reactions during stressful economic periods. Few investors fail because of bad funds. Most fail because their emotions sabotage reasonable plans over long horizons. Designing a portfolio around human behavior dramatically improves the odds of long-term success for ordinary investors everywhere. Now, let's bring everything together and revisit why this approach works for ordinary people seeking calm financial lives. The goal has never been excitement. It has always been freedom, stability, and long-term peace for everyday investors. Before we finish, I want to reinforce the simple philosophy guiding every decision I've shared throughout this video. This philosophy accepts uncertainty, respects time, and prioritizes behavior over predictions that often mislead individual investors long-term. I don't need to predict recessions, interest rates, or headlines to succeed with a disciplined long-term approach. Instead, I rely on diversification, low costs, and patience to do most of the heavy lifting over decades. This mindset frees me from constantly checking prices and reacting emotionally to short-term market noise every day. It allows investing to fit into my life quietly, rather than consuming attention and energy daily unnecessarily over years. If you remember one thing, remember that simple strategies followed consistently often outperform complex plans abandoned early eventually. This is why I avoid trading, not because it's bad, but because it invites unnecessary mistakes over time. Calm investing doesn't feel exciting, but excitement rarely builds lasting wealth for ordinary people consistently over decades financially. What builds wealth is staying invested, reinvesting income, and giving time the chance to compound effectively long-term. Cut. If you're watching this and feel overwhelmed, know that simpler approaches are often the most powerful for long-term investors. You don't need perfect timing, advanced knowledge, or constant action to build meaningful wealth over your lifetime successfully. You need a plan you can stick with when emotions and headlines try to pull you away financially. That's why this no-trading, low-stress approach remains my preferred way to invest long-term consistently over decades. If this perspective resonated with you, let me know by liking the video or commenting below right now. I'm aboard. Sharing this video helps others discover calmer ways to invest without fear or unnecessary complexity long-term successfully. And if you want more content like this, subscribe to see future videos as they're released consistently here. I focus on helping people build wealth calmly, realistically, and sustainably over many years, together with simple strategies. Thank you for spending your time here and thinking seriously about your financial future today with me now. Remember, the goal is not excitement, but freedom, confidence, and peace over the long run for your life. Before you leave, I want to summarize the entire approach into a few practical, memorable ideas for long-term investors. First, investing does not need constant action, because inactivity paired with discipline often produces better results over decades. Second, low costs matter more than clever predictions, because fees compound against you every single year relentlessly. Third, diversification is not about maximizing returns, but about surviving mistakes, emotions, and unpredictable market environments calmly. When these principles work together, investing becomes boring, repeatable, and far more reliable for ordinary people like us. This is how I personally invest $10,000 without trading, stress, or constantly questioning every market movement. I trust time, compounding, and simple structures more than forecasts, opinions, or emotional reactions to short-term noise. If you follow this approach, your biggest challenge will not be markets, but staying patient during quiet periods. Quiet progress feels slow, but it often leads to the most meaningful financial outcomes later in life. Investing should support your life goals, not become a constant source of anxiety, obsession, or emotional pressure. Work. When money works quietly in the background, you gain more freedom to focus on family, health, and purpose. This philosophy may not impress others, but it has helped countless investors build wealth steadily over time. If you're starting today, remember that consistency matters more than perfection, especially during your early investing years. $10,000 is just the beginning, not the finish line, when paired with time and discipline. Small steps taken consistently often outperform bold moves taken rarely or abandoned prematurely under emotional stress. 2. I hope this video helped you feel calmer, clearer, and more confident about investing long-term responsibly. If it did, liking and sharing helps this message reach others who may need it today. Subscribing ensures you won't miss future videos focused on calm, realistic, long-term wealth-building strategies. Thank you for trusting me with your time and attention in a world full of financial noise. Remember, the best investment strategy is one you can actually follow peacefully for decades without quitting.